The modern financial market is a relentless, autonomous ecosystem of machines. Take the foreign exchange market, where world currencies are traded. Over $7 trillion flow through this system every day, with trades executing in microseconds. This environment creates high-speed liquidity cascades, a digital river where algorithms hunt for micro-opportunities that appear and disappear in the blink of an eye. A human trader watches a single line move slowly across a screen. Inside the machines, millions of individual orders are colliding every second. High-frequency trading firms account for the vast majority of all trading volume. They stay profitable by capturing tiny gains, often just a fraction of a cent, across millions of transactions. Institutional traders dominate this world by deploying artificial intelligence that perceives the market in a way the human eye cannot. To navigate this data, advanced AI looks at price charts as literal images. It uses a system called a convolutional neural network, which identifies patterns in images similarly to how a person recognizes a face in a crowd. This chart shows data as a candlestick. Here, a green candle completely covers the red one, a key pattern called a bullish engulfing. Because the green closes higher than the red opened, the AI signals the price will shift upward. The AI processes this instantly by shrinking the image data, compressing a larger grid into a smaller one. This step, max pooling, throws away market noise and keeps only the most intense signals from the chart. These simplified grids pass through multiple layers of analysis, shown here in 3 dimensions. The AI funnels the visual data down until it reaches a final, simple decision to either buy or sell. Treating financial math as a visual problem, the AI identifies a profitable setup fractions of a second before a human can focus on the screen. However, this digital ocean contains hidden dangers. Not all trading activity is safe to interact with. Sometimes a flow of orders is toxic, meaning the buyers on the other side have superior information. If an algorithm trades with them, it is almost guaranteed to lose money. The market's heartbeat is always changing, shifting from a slow rhythm to an erratic cluster of spikes in an instant. When the AI identifies these toxic spikes, it immediately cancels its orders, pulling its money out the very millisecond it detects a trap. This self-preservation has massive consequences. When thousands of algorithms detect a trap and withdraw simultaneously, the sudden lack of liquidity triggers a $1 trillion flash crash. Survival in this world depends on more than just attacking. It's about recognizing the pattern of a trap and knowing when to hide. With millions of algorithms battling and canceling orders in microseconds, you might wonder how the market stays stable. All this chaos resolves in a moment of market synthesis. It is a balancing act where millions of moving parts finally lock into place to create a single price. This is the moment where trend followers, neural networks, and market makers finally intersect and agree on a value for a brief moment. That invisible war resolves into something incredibly simple: the single updated price blinking on your phone screen. Every time a currency price changes by a single cent, you are seeing the exact point where all those competing machines finally stopped fighting and agreed on a number.